Here's a question that sounds simple, but trips up almost everyone. If two people buy the exact same car, and one of them pays £200 less a month than the other, who got the better deal? Most people say the one paying less, and most people are wrong. I've watched friends, family, and honestly my younger self make this exact mistake, picking a car deal based on what leaves the bank account each month without ever working out what it's actually costing them over the years they own it. And car dealerships know this. It's not an accident that every advert, every window sticker, every sales pitch leads with the monthly figure. It's the number that's easiest to make look small. Today I want to walk you through every real way you can pay for a car in the UK, run the actual numbers on a real example, and show you the trap that catches almost everyone, plus the one financing option most dealerships would rather you never think about. I'm Rich Mind Finance, and this channel is all about building real wealth through decisions most people never stop to question. If that's your thing, hit subscribe and tap the bell. New videos land every week, and this kind of breakdown is exactly what we do here. Let's get into it. Section 1. 3 ways to pay, 3 different deals. Forget the jargon for a second. Every way of paying for a car in the UK actually falls into one of 3 buckets. Bucket 1. You own it from day one. That's buying outright with cash, or taking out a personal loan from your bank, completely separate from the dealership, and using that money to buy the car yourself. Either way, the car is yours the moment you drive off, no strings attached to the dealer. Bucket 2. You own it eventually, if you choose to. This covers hire purchase, where you pay off the full value of the car in installments and it becomes yours at the end. And PCP, personal contract purchase, where your monthly payments only cover the car's expected drop in value, and you decide at the end whether to pay a final lump sum to keep it, hand it back, or trade it in. Bucket 3. You never own it at all. That's leasing, sometimes called personal contract hire. You pay an initial rental and then a fixed monthly amount for using the car, and at the end, you simply give the keys back. No decisions, no selling, nothing to think about, but nothing to walk away with either. 3 buckets, 5 options. And on paper, they can look wildly different in terms of what leaves your account each month. So let's actually test that with real numbers. Section 2. The numbers. A real comparison. Let's use a Volkswagen Golf, a genuinely popular choice in the UK, priced at £28,000. We'll assume a strong credit score and a 4-year ownership window, so we're comparing like for like. Buying outright, £28,000 gone on day one. Nothing more to pay, ever, for this car. Personal loan. Say you borrow the full £28,000 from your bank at a competitive rate. Over 4 years, with interest, you'd typically repay somewhere around £610 a month, and you own the car immediately, same as buying outright. Hire purchase. Put down a £2,800 deposit, and your monthly payments land around £630. By the end of 4 years, you've paid roughly £32,900 in total, and the car is fully yours. PCP. Same £2,800 deposit, but because you're only paying off the expected depreciation, your monthly payment drops to around £415. At the end of the term, there's a final balloon payment of roughly £11,500 if you want to keep the car, bringing your total spent to around £34,300 if you pay it. Leasing. Instead of a deposit, you pay an initial rental of about 3 months' payments upfront, around £900, and then roughly £300 a month after that. Over 4 years, total cash spent is about £15,300. You never own the car, so there's nothing left at the end to sell. Look at that lineup on monthly payment alone, and leasing wins by a mile. PCP comes second, and buying outright looks like the expensive choice. That's exactly the story dealerships want you to walk away with, but it's only half the story. Section 3. What you actually walk away with. With buying outright, the loan and hire purchase, you own the car at the end of those 4 years. Based on typical depreciation for a car like this, it might still be worth around £13,000. That's real money you can get back by selling it. With PCP, you only get that value back if you paid the final balloon payment to keep the car. If you handed it back instead, you walk away with nothing extra, but you also avoided that £11,500 lump sum. With leasing, there's simply nothing to sell. You handed the car back, full stop. So once we subtract what you'd realistically get back from resale, here's the real 4-year cost. Buying outright, £28,000 minus £13,000 resale equals £15,000 net cost. Personal loan, roughly £29,300 paid minus £13,000 resale equals £16,300 net cost. Leasing, £15,300 net cost. No resale involved. This figure doesn't change. Hire purchase, roughly £32,900 minus £13,000 resale equals £19,900 net cost. PCP, buying at the end, roughly £34,300 minus £13,000 resale equals £21,300 net cost. Suddenly the ranking flips almost completely. The option with the lowest monthly payment, PCP, turns out to be the single most expensive expensive way to actually own this car. And the personal loan, the one option barely anyone at the dealership will bring up because there's no commission in it for them, comes out close to the cheapest, right alongside paying cash. That gap between what something costs monthly and what it costs in total is where most people quietly lose thousands of pounds, not through one bad decision, but through never being shown the second half of the math. Section 4. The 3 traps to watch for. Numbers aside, there are 3 traps worth naming before you sign anything. Trap 1. The small number illusion. An extra 8,000 pounds on a car feels enormous as a single figure. Spread across 48 months, it becomes just another 165 pounds a month, and somehow that feels far more reasonable, even though it's the exact same money. Always translate a monthly figure back into its total before you decide it's affordable. Trap 2. Mistaking a low payment for a smart decision. As we just saw, the cheapest looking option each month was actually the most expensive option overall. If keeping monthly outgoings low is genuinely your priority because of your income situation, that's a completely valid choice. Just make it with your eyes open, not because the sticker in the window made it look like a bargain. Trap 3. Ignoring your own timeline. If you tend to keep a car for 8 or 10 years, buying almost always wins, because you spread that early depreciation hit over a much longer stretch. If you like changing cars every 2 to 3 years and hate the idea of selling one privately, leasing might genuinely suit your life, even if it's not the cheapest option on a spreadsheet. There's no universally correct answer here, only the answer that fits how you actually live. Before you finance anything, ask yourself just 2 things. How long am I actually planning to keep this car? And am I choosing this deal because it's genuinely right for me, or because the monthly number was the smallest one on the page? So that's the real breakdown. Not just what each option costs per month, but what it actually costs you once the car is sold, traded, or handed back. If this helped clear things up before you sign a finance agreement, do me a favor and send it to someone you know who's currently car shopping. I promise it'll save them more than the 9 minutes it took to watch. And if you want more of this, real numbers, no fluff, straight talk about building wealth, make sure you're subscribed to Rich Mind Finance and tap that notification bell so you don't miss next week's video. See you then!